So topic 3. So topic 3, we're talking about the regulations and other principles guiding the accounting profession. So now, as I had said earlier, the accounting profession has got regulations that are followed. The accounting profession has got regulations that are followed. The accounting profession have got regulations that are followed by all the accountants so that we make sure that the quality of the financial statement that we prepare are up to the standard. So we are going to look at the principles. We want to start with one, principles. Principles, just as I've projected on your screen, principles, concepts, and conventions, and conventions, underline the accounting reports. Underline the accounting report. So what are the accounting principles? The first principle, or the concepts, accounting concepts. Let's start with the accounting concepts. Accounting concepts. Accounting concepts. So the first concept that we have in accounting, we have concept number 1, which is called going concern. I list them first of all before I explain them. We have the going concern concept. The other one is the accounting period concept. Accounting period concept. The other concept is business entity concept. Number 3, business entity concept. 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 Then the last one is the monetary principle. Number 4 is monetary principle. Monetary principle. Monetary principle. So we start with this, the first concept, which is the going concern concept. Now, when you talk of the going concern concept, what we refer to as here is that whenever we are preparing the financial statements, then we must prepare them with the view that the business will not be closing down soon. For instance, if you are an accountant and you are preparing the financial statements for a company, you must prepare those documents with the view that the business will continue operating in the unforeseeable future. That's what we call the going concern concept. Going concern, meaning the business is not intending to close down soon. The business is intending to operate or to be in business for forever in the future. So that's what we refer to as going concern. For instance, I want to give you an example. A big company such as Safaricom, there is no day we can wake up and find that Safaricom has closed down or has collapsed. Because according to the accounting principle, a business should be established with an aim of existing for a very, very long period. So when you talk of this principle, we call it going concern principle. Let me just take you back a little bit. Accounting regulation and other principles guiding accounting profession. This is what we call the accounting theory. It is the basis, it's the explanation of what accounting is. It's the explanation of how accounting operates. Just like any other profession, look at medicine. The doctors, they have some principles guiding their work. Look at the engineers, also they have principles guiding their work. I want to give an example of physics. In physics, for those who learned physics, there was something called the Newton theory or Newton principles. Now, if you look at physics, for those who did physics, you learned some principles about Isaac Newton. And Isaac Newton was giving the guideline on how physics works. Force, like force is equals to something. Force is equals to what? To work, I don't know, plus direction. Yes, force. Or work is equal to force plus direction. So in accounting also, we have principles that guide the accounting profession. Also, those who learned chemistry. You learned about pressure. Pressure is equals to volume over area. Or area over volume, such things. These are the principles that were guiding this profession. So whoever you are, whether you are in America or anywhere, you are going to use the same principles. So I'm saying this so that I can bring you to understand what we refer to as regulations and other principles guiding accounting profession. It is in the syllabus. And the examiner might throw one or two questions inside there so that to test if you understand the principles guiding an accounting profession. So you being the first time trainer in the accounting profession, it's important for you to understand the basis or the genesis of all these things that you do in accounting when it comes to the principles. So be very careful and understand these principles, the accounting principles. So you understand the going concern. So when you talk of going concern, this concept ensures that businesses continue to operate until perpetuity. Perpetuity means something like forever. So the reason as to why the going concern concept is important is because Businesses have got people who have invested their money in them. So if you are aware that a business that you want to invest your money into is going to be closed next year or in the next 2 years, can you put your money into that business? Stacy, ukisikia leo Safaricom is closed in the next 2 years, can you invest in Safaricom?
No.
Yeah?
No.
No, yes. So it's common sense. So what accounting dictates is that any business, the financial statement should be prepared in the going concern format. Even you now, if you open a business, I don't think you'll be opening a business with a plan to close it. So the business that you open, your plan will be that the business will continue operating forever so that you benefit from it. So in accounting, every business or every financial statement that we prepare it with a view of existing for the longest time possible. Then we have the accounting period concept. The accounting period concept, this concept dictates that every business lifespan, every business lifespan is divided into stages. A business have got a lifespan that is divided into stages. Now, let's refer to the first principle, which was saying the going concern. We've said going concern, a business life will exist forever. So let's say this is business ABC. Its life will go on forever. So this is start. And then this is perpetuity. Perpetuity means forever. Perpetuity or forever. And foreseeable future. Now, we know the time when it started. We know when the life of the business started. Because every business have got a time when they started operating. Look at a company such as Royal Media, Citizen TV, Citizen Radio. Those businesses started in the 90s, not long time ago. But there is no day we can say by this time, Citizen or Royal Media will have closed down. We can't tell. The owner have got no plan of closing it unless something worse happens. So in that case, the going concern now comes what we call the accounting period concept. Now we know that the life of a business is going on forever. But in this process, the life of business, the business is divided into stages. These are the stages within which we check. So when we talk of the accounting period concept, so when the business started, in between there are stages. These stages are what we call the accounting period. Meaning after every 1 year, so this is 1 year, another 1 year, another 1 year, another 1 year, 1 year, so forever. So what this concept is telling us that despite the fact that the life of the business is going on forever, it is divided into financial years, which we call the annual periods. After every 1 year, we have to review the business. After every 1 year, another 1 year, we have to review the performance of that business. So when you talk of the accounting period concept, it just refers to the annual, annual division of the lifetime of a business. It refers to the annual division of the lifetime of a business. So life of a business is divided into years, despite the fact that it will exist forever. So that's what we call accounting period. And again, the reason why we prepare the financial statement is to review the performance of a business after 1 year. So that's what we refer to as the accounting period. All that is here on your notes. The other one is what we call the business entity concept. So this is okay. So when you talk of business entity concept, what this concept refers to is that the owners of the business are separate from the management and the operations of the business. Basically, what we refer to as here, if you have a business, a big business, the owners are not allowed to manage the business, or the wealth or the asset of the business are not supposed to be owned by the owners. For instance, look at Naivas, it's a big supermarket. The owners of that supermarket are not allowed to be part of it. Or the buildings that are owned by Naivas are not the same buildings that are owned by the owners. The owners of the business and the business must be separate entities. So that's what we refer to as business entity concept. Basically, what it refers to is that owners and the business are two and different bodies or persons. For instance, look at the Royal Media. Look at Citizen TV. Citizen TV is a business with its own wealth, with its own assets. So if Citizen TV owns a building, it cannot be that the same building is owned and claimed by the owner of the Citizen TV. The two must be separate. Again, if the owner of the Royal Media has got his own personal house, the business cannot claim it that is its own asset. So that is important. For instance, if you start a business now and you have the business have managed to generate profits and you have bought a motor vehicle, a house, and the rest, all those things belong to the business, not to you. You are just the owner. The two of you must be separate, totally separate from the ownership of the business. The other concept is the money principle. Money principle, meaning all the things, all the figures that we use whenever we are preparing the financial statement must be in terms of money. Are we together? I want to give an example. From the previous lessons that we've been studying, even the two statements that we prepared, we have seen that all the figures that were there, they were in which form? Yes, Roland. All the figures that we have used when we were preparing the balance sheet, the financial statements, they were in what form?
Money form. Money.
Yes?
They're in money.
They were in money form. Very good. They were either in Kenyan shillings or USD. Not, you know, if you look at engineers, their main unit of measurement is what? kgs, CPO. Yeah? Length, let's say they want to measure the length of a road, they will use meters, kilometers. When they want to measure the weight of some machine, they use kgs. A doctor will use temperature. If they want to know that you are sick in what form, they measure your temperature. They will measure what? Your kg, your weight, volume of your blood. All those are units of measurement. But in accounting, what is the unit of measurement? Yes, Teresia? Teresia, you are there? Teresia, you left?
No.
What's the unit of measurement in accounting? Yes? It is money. That's what we refer to as money measurement or currency. That's why you see in the that we prepared, if you say 10,000, we know that 10,000 is Kenya shillings, or USD, or euros. So you have to measure, all the accounting measurements are done in terms of money. All the accounting measurements are valued in terms of money. All the figures in the accounting statements is based on currency or money form. That's what we refer to as monetary principles. So now, if you look at the financial statements, let's say you go and take the financial statement of Safaricom right now, you'll find that all the financial statements are prepared based on these principles. Because these are the principles. Look at the car that you drive, for those who have cars. That car has been manufactured using certain principles. When it comes to speed, they have used the principles of Isaac Newton when it comes to speed. When it comes to maybe weight, the weight of the car, it has been prepared based on a certain principle. Because if you have a lorry, the lorry is going to carry some load. The load weight and the mechanical setup of the vehicle have followed a certain principle. Let's say for now you want to go to space, you want to go to Mars or the moon. There are principles that will guide your work or your project of going to the moon. So I'm trying to say all this to make you to understand what we are talking about here. So when it comes to accounting, accounting also have got some principles that guide how we go about preparing the financial statement or how we go about our work as accountants. And these are the main principles or concepts of accounting. Now, someone might ask, what is a concept? A concept is an idea. We'll talk about a concept. A concept is an idea behind a whole thing. For instance, let's say you have a bedroom and you like oceans. You like how the ocean looks like or the beaches. So when you are painting your room, you paint it with a concept of the ocean. Are we together? Or you like the wilderness, such as Masai Mara, and when you are now painting your bedroom, you paint it with a view of Masai Mara. So that view, that idea that gave the painting of your room is what we call a concept. A concept is just an idea that gave you into doing something. So when we are preparing our financial statement, these are the concepts. So when you are preparing your financial statement, the concept behind it in your mind that the business will go on for long, and then the period is 1 year. The business is separate from the owners, and then the figures are in terms of money. So that's what we call a concept. Then we look at the principles also. Any question on that part? Now let's look at the accounting principles. So now, just as we've talked about concept, is also what we call principles. What are the principles? Someone like you have your own principles. You can say, that's not, I'm a principled person. So when you say I'm a principled person, what do you mean? It means there are things that you have to do and there are things that you can't do. Sindio? Sindio, Sister Teresa?
Yeah.
Yeah?
Yeah.
Yes,
True.
so accounting also is like that. There are things that accounting allows and there are things that accounting does not allow. Just you like you a human being, kuna vitu unakubali na kuna zile vitu unakataa. You even swear, I can't do that, or I must do this. So in this profession also, there are things that guide it. And the first one is what we call historical cost. The first one, so we are talking about the accounting principles, we are through with the concepts. So the first one is historical cost. Historical cost. I will explain. Now, when you talk of historical cost, what we are trying to say is that whenever you are preparing your financial statement, the value that you attach to the things that you are doing must be historical. I want to give you an example. If you buy this, if I bought this phone at 50,000 30 years ago, or let's say 5 years ago, I bought this phone at 30,000 3 years ago. Now, when I want to tell someone the value of this phone, how much should I tell him? I should tell him this phone is valued at how much? Yes. Can I say it's 30,000? Yes, Ronald. Can you still say it is 30,000? Why? You are saying no. Why? Why are you saying no? Yes, why no, Bernard? Why no? Yes?
Because maybe it has depreciated.
Very true, it has depreciated. But now in your financial statement, it will appear as there as 30. In the financial statement, the value of the fund will still appear as 30, because that's what we call historical cost. Historical cost concept principle does not allow us to increase the value or decrease the value of an item, but it allows depreciation. So let's look at another example we call land. Let's say we bought land at 10 million 20 years ago. In our financial statement, the historical cost principle dictates that that land should still appear as 10 million, despite the fact that the value of the land should have gone up, because land appreciates in value. Land is the only asset that increases in value. So after realizing that the land has gone up in value, the accounting principle of historical cost does not allow us to value the land at the new value. We are supposed to value it at 10 million. So as we go forward, we'll see how the challenges of these principles, because they have challenges. Just as I've given you examples of two assets. One, a phone depreciates, meaning a phone that you bought 3 years ago should not be the same value. Again, land appreciates. If you bought land 10 years ago, the value of the land should go up. But according to the accounting principle, we are supposed to record the values of those items as per the historical cost. When we talk of historical cost, we mean the value that we bought it long time ago. History is something that has happened. So the value the amount of money that we used to buy the asset is still the value or the amount of money that we should record as the value of that asset. But as we go forward in learning, as we go forward with learning the accounting, the financial accounting, we'll realize that there's a way of dealing with the problem of depreciation and revaluation. But if you're asked in the exam, accounting principles, make sure you did this and explain. So we list the value as the original cost. Then we have monetary principle. Monetary principle is more or less related to what we have just talked about. So we have monetary principle. Monetary principle. This principle holds that accounting will only endeavor to deal with those items which a monetary value can be attached. As such, financial statements reflect only the items that can be measured in monetary terms. Goodwill, for example, is never shown in the statement because it has no monetary measurement. Now, this is more or less related with what we just talked about. So in accounting, anything that does not have monetary value is not supposed to be included in preparation of the financial statements. For instance, if your company has got a good boss, he is so good, he understands his workers, he is so gentle, he is so generous. Is that something good to the company? Stacy, is that something good to the company? If you have a good boss where you work, he works, yeah, and he is good with employees. Is that something good to the company?
No, according to accounting, no.
Yeah?
No.
No, that's something positive. Yeah, it's good to the company. You don't want a bad boss because he will demotivate staff. It's a good thing but it is not an accounting information. So a good boss, however good he is, it can't be recorded as accounting information. He cannot be an asset to the company. Again, if you have a terrible boss who sacks people, he's a liability to the company, but we cannot record it because it's nothing to do with cash. It has got nothing to do with the money. So anything in a company that does not involve money, don't bother yourself with it if you are an accountant. Even if you employ someone who got first class, someone who does wonders in a company, he's good at his work, but it's nothing when it comes to accounting. So what am I trying to say? Accounting deals only with things that are monetary in value. However minute it might be. Let's say you have spent 20 shillings. Accounting will need you to recognize that 20 shillings in a company, even if it is 5 shillings. But if anything, what has happened and it does not involve money, accounting has got no business to do with that. So when you talk of monetary principle, this is the principle that gets accountants. If the company has done something that involves money, it's when you come into it. Are we together?
Yes.
Now, if people fought,
Yes.
let's say last year, there was a strike in a factory, and the factory stopped. Obviously, it has an impact in the business, but it has got no impact in accounting. Because it's a non-accounting event, nothing happened. But if during the strike, there was some involvement of money, there were some things that were broken down and they were replaced or they were bought using cash, that's when the accounting comes in. But it did not come into mentioning that there was strike. It did not come into mentioning there was some breakages. It will only come into mentioning purchases, purchase and repairs. Accounting doesn't go into details, into pettiness. Accounting is not petty, basically, that's what we say. Accounting is not petty, into explaining non-financial details. So when we talk of monetary principle, that's what we refer to. This guides accountants to only touch things that deal with money. Kitu yote msichani na pesa, my friend, don't get involved. You are HR. So that's what we call monetary principle. Then number 3, the other principle is the accrual concept. Accrual concept. Accrual concept. Now this one, some of you have seen this one for the first time. It's called accrual. Accrual. Under accrual concept, we have other 2 things. We have prepayment, and then we have prepayment, and then we have matching concept. Matching concepts. Now, when you talk of accrual, you have to listen carefully to this. This is very, very, very tricky. Now, I want to give you a scenario, then you will tell me how to go about it. Let's say I'm doing business and I've sold some goods to Ronald or to Stacy or to Teresia or to Millicent, those who are in plan. I've sold to you goods worth 10,000 and you're going to pay next month. How am I supposed to go about that transaction in my books? Am I supposed to recognize a sale immediately, or am I supposed to wait until when you pay to recognize that I have made a sale? How do we go about it? Yes, Ronald. Ronald, how do you go about that?
You sold on credit.
Yes, I've sold an item on credit worth 10,000, and I've given you 1 month to pay me back. I've given you up to next month on 11th to pay me the 10,000, the credit period. In my own books, am I supposed to recognize that I've done a sale, or am I supposed to wait until when you pay me back, you pay the amount in November, on 11th March to recognize that I've sold? Now, how do you go about it?
You're supposed to wait until the payment has been made.
Wait for the payment. That's when I'm supposed to recognize that I've sold, yeah?
Yes.
Yeah?
Yes.
For
Okay.
me, you are supposed to
That is my answer. Someone else to give me the answer. That's Ronald's answer. Yes? Yes, Stacy.
I think you record immediately when you make the
Very true and
when you sell.
very good. When you talk of accruals, accrual data concept, you're supposed to recognize a sale once goods have changed ownership. Once goods have changed ownership, you have to recognize a transaction called a sale. You are not supposed to wait until cash comes in. If everybody was waiting for cash to come in, then there will be a lot of confusion. So once goods have changed ownership, you have to recognize a transaction called sale, despite the fact that you have not received the money into your hands. So that is important. So when you talk of accrual concepts, you can say sale is recognized and recorded once goods have changed ownership. That is from the seller to the buyer. Even if payments have not been made. So if you look at that, you'll understand that. So accrual, so that's what we refer to as accrual basis. Then there's something we call the prepayment. Now, when we talk of prepayment is when you have paid for a service, but you have not gotten it. You have paid for a service, but you have not gotten it. So now, how do we go about it? For instance, I know most of you don't pay rent, or if there are some, I don't know. If you are planning to travel to America, or you are planning to have a holiday in Mombasa, there are companies that will ask you to pay first, isn't it? They ask you pay first, you book the hotel first before you go or before you travel. Now, the payment that you make before you receive the benefits is what we call a prepayment. For instance, insurance, you normally pay for insurance before you get the benefits of the insurance. Even in Kenya, matatu, if you are traveling to Kisumu now, you will go online and book a vehicle to Kisumu, but hujaenda. You see? Now, if that happens, that's what we call a prepayment. You have paid, but you've not gotten the benefit of spending your money. It's what we call a prepayment. Now, prepayment are recognized as assets because you paid, but you've not gotten the service. So we have to recognize them. So we are being told here, the accrual concept is also known as matching concept. So this one should be here, stroke matching concept. So it should not be here. Are we together? Now I've explained what prepayment is. Then you are being told, In this principle, revenue and cost are recognized when they are earned or incurred, and not as the monetary attachment is received or paid. What this means is that time when the revenue is received or the expense incurred is completely disregarded. This leads into two scenarios, the prepayment and accruals. So the second one is accrual. So don't confuse. This one also is called accrual, but if you look at the major concept is called accrual concept, but it has got two divisions, which is prepayment and accruals. I'll explain accruals also. Now, I've explained the prepayment, and now I want to explain the accruals. Now, accruals is the opposite of prepayment. We say prepayment is where you pay before you get the benefit. Now, accrual is whereby you get the benefit and pay later. You enjoy the benefits and pay later. For instance, those who are employed, are you normally paid salary before the work or after the work? How do we go about it? Or those who know people are employed, are you paid salary before the work or after the work? Yes, Millicent.
After the work.
So after the work, meaning the employer enjoys your work, the employer enjoys the benefit of your labor, then he pays you later. See?
Yes.
Now that's what we call accruals. It's the opposite of prepayment. So here you pay after, here you pay before. So in accounting, you are required to recognize expense. You are required to recognize an expense if you receive benefits before paying for them. That's a liability. That's an expense that's supposed to be paid. So accruals, whenever you are preparing your statement of financial position or your balance sheet, you recognize the accruals. If there is any amount that's accrued that has not been paid, that's a liability to the business. But this one is an asset. Accruals are liabilities, prepayment are assets. Because in prepayment, someone is holding your money, but you have not received the service. So it is an asset. But the opposite is accrual, which is true. Someone has given you the service, but you have not paid. So in that case, we have it there. And then again, to explain further, when it comes to matching concept, matching concept and accrual concept are same thing, but I just want to explain something else here that will help you understand it. In accounting, for every benefit, there must be a what? A sacrifice. Now, don't write this in accounting. Don't write this in your exam paper. This is just to explain. Don't go there and start writing non-accounting things. But now, given that you are new in this field of accounting, I have to bring out the concept in a way that I believe you guys will understand. So some of these things that I'm writing on this side, please guys, don't go write them in the exam paper. Now, for every benefit, there must be a sacrifice in accounting. Or let's use accounting term, for every income, there must be what? An expense or cost. For every income, there must be a cost incurred. That's what we call what? Matching concept. Even in real life, that's how it works. For every benefit, there must be a sacrifice. If you get a situation where you are just benefiting without sacrificing, you should doubt what is going on in that place. Accounting also has got that mentality. For every income, there must be a cost. For every expense, there must be a benefit. You see? So that's what we call a matching concept. That's why I was telling you about the payment and accruals. And I also give you an example that if you give your goods, then you must match it with what? With a benefit. So we say if you sell on credit, if you sell your goods on credit, what are you supposed to match it with? You should match it with debtors. You know this is an asset. And this is what? Your assets have gone out, you've given your goods in terms of sale. So you have to match it with what? With this. So outflow of assets, outflow of stock. So for every income, we must match it with an expense. Again, just to enlighten you, let's say you have made sales, worth 50,000. There must be an equal sacrifice of 50,000 or more or less. So let's say you've gotten sales of 50,000. This is income. There must be a sacrifice of equivalent to 50,000. And these are things such as expenses. Expenses such as rent, salaries, cost of sales, all this might be equivalent to this, or more, or less. So if the sacrifice is less than the income, you will get profit. But if the income is less than if the sacrifice is more than the income, you will get what we call loss. Get a loss. So when you talk of matching concept, it's just matching income and expenses, or matching your revenues and your expenses, or cost of revenue. Cost of revenue. The two must be matched. Is that okay?
Yes.
Now let's look at the next. The next principle is what we call the revenue realization concept. Revenue realization concept. In fact, I've explained this one from what we have just explained here. We have explained, so but I'll do more again. Revenue realization concept. Now, this is a concept that just guides the accountant on when to recognize revenue. This is the principle that guides the accountant on when to recognize revenue. Now, again, let me give you an example. You have a shop in town. Nasikia Teresia, Sister Teresia. You have a shop in town, then in your shop, someone has come and asked for the price of whatever you are selling. Can you say that you made a sale?
No.
Ama, you have a shop and you do online sales. Then someone has sent you a message on your TikTok or on your WhatsApp or whatever, asking for the prices of whatever you are selling. Are you supposed to say, recognize that you sold something?
No, you're not supposed
No.
to do that.
It is illogical, yeah? It doesn't make sense that someone have just asked you for the prices and the quotation, then you recognize a sale. Now, the selling process is so huge. The selling process can be so long. It starts with inquiry. Someone will ask for the goods, the prices, the quality, and the quantity. Then from there, they will ask you, maybe, are you able to deliver those goods? It's a long process. It involves a lot. Then they'll ask you for the price list. They ask you for a quotation. they ask you how the items work, all that process is not recognized by accounting. That is nonsense. That is zero. Accounting will come into play the moment all these procedures are through and you have taken the goods to the buyer, and they have recognized that you have delivered the goods to them, and the goods are not in your premises anymore. But up to the end, even if they promise you everything that I'm going to buy, I'm ready, I'm coming, don't recognize a sale, don't recognize a transaction until when the goods are moved from your place to the buyer's place, and also the paperwork is okay. When I say the paperwork is okay, they have given you an LPO, local purchase order. Local purchase order is a document that is used to do purchases locally. It's a commitment that someone is going to pay. So that's when your accounting work begins. So that's what we call revenue realization concept. Meaning, we only recognize a sale or an income. Revenue is income. Revenue refers to income. Revenue refers to income or sale. So don't recognize any revenue until when goods have moved from your space to someone else's place. So that's what we refer to as revenue realization concept. Now, the other concept we call it prudence. What does prudence mean? Prudence. Yes, Stacy, what is prudence? Yes. Stacy, what is prudence? Yes, Stacy, what is prudence?
I don't know.
Yeah.
CG.
Ronald, what is prudence?
Yeah, I can say it is where there is alternatives. The one selected should give the most cautious presentation of the financial. Where there are alternatives, the one that is stated should give the most cautious presentation. The financial position.
The keyword there is cautious. In fact, you guys can read it there. See, Stacy, are you not seeing the shared screen? So when we talk of prudence, this is whereby it is dictated that accountants should be very, very, very cautious with figures. Accountants should be very, very cautious or conservative. Be conservatives. Don't give figures that you are going to be seen as exaggerating income. So when I talk of prudence, if you read there, we are being told, prudence says that where, so Ronald tulisoma tu hapa bana. Prudence says that where alternatives exist, the one selected should be the one that gives the most cautious presentation of the financial position of the business. Assets and profit should not be overstated, but a balance must be achieved to prevent the material overstatement of liabilities and losses. Where losses foreseen, it should be anticipated and taken immediately into account in other words, accountants should never anticipate for gains, but always provide for losses. Now, when you're an accountant, you should be always negative when it comes to profit. You should always be cautious to record a profit. But you should be more, you should exaggerate in quotes losses. And that's the nature of accountant. They always say, oh, I don't have money. Those who drive to the accountant, they are very, very, very cautious and negative. You ask them for money, oh, I don't have. You ask them, can you go for a holiday? No, 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 no. It's their nature because they have been trained. Now, that is an accounting principle because chances of exaggerating income are so high and the impact will be so big. For instance, if you exaggerate, for those people who live fake lives, you see, those who live fake lives, you know, they exaggerate things that they have or the money they earn. When now reality comes and hit them, it normally ends bad. So we accountants try to avoid exaggerations. They try to avoid people believing that things are okay. People should just see that things are okay, but don't start saying, oh, we are going to collect a lot of money from debtors. That's why whoever who asks about the provision for doubtful debt, that provision for doubtful debt comes from this principle. In fact, everything in the accounting statement is here. It comes from all these principles. So whenever you are dealing with debtors, what you are doing in calculating for the amount that you will not collect is what we call prudence. I give you an example of 20 people owing you 100K. According to accounting, you should assume that you will not get back that money. You should assume, oh, someone is owing 100K. You should be assuming that that money will not come back. If you use the principle of prudence. Because you should always think of the worst. Accountants should think of the worst. What if those 20 people died? Corona imekuja wakakufa wote. Or walipanda gari moja ikapata ajali wakakufa wote. You've lost your money. You should always think of the worst. So when it comes to income, you should always underestimate. And expenses, stop losses, overestimate. Now, say you estimate in figures. So when this is pessimism, you should apply pessimism. You should be pessimistic when it comes to income. But this should be optimistic. Meaning you recognize that something bad might happen and you lose your money. Here. Then here also, you always expect the worst. So that's what we call prudence. You should be careful. Accountants should be careful whenever they're dealing with figures of income and expense. Then the other principle, we call it the principle of consistency. What is to be consistent? Millicent, what is to be consistent? Yes?
Being consistent means doing the same thing over and over again, like repeating it
Yes?
generally. Doing the same thing over and over again, it may also be referred to as a repetition.
Doing something in the same way for a certain period. Now, accountants should be consistent in what they do. In preparation of the financial statement, you should be consistent. See, I think, Leo, This year, you are preparing financial statements using a vertical format. Next year, you are preparing the financial statement using a horizontal format. No, no, no. We want consistency. So you should be consistent. Meaning, if you're using a certain method of preparing the accounts, you should use that method forever, not for a long period of time. And a good example is, if your financial year starts in January to December, it should be that way forever. Or if your financial year starts in October and ends in October the next year, so this is October 2024, it will end October 2025. So that should be always your financial year. Don't start changing at your, and I told you, financial year in accounting is not only January to December. Financial year in accounting concept does not mean January to December. It is when the business began, and then it counts 12 months. If ukianza biashara leo, what will be your financial year? Your financial year will end by when? If you start a business today or on 1st February 2024, your financial year will end on which date? Yes, Ronald.
It will end on 1st February 2025.
First?
Feb 2025.
Wrong. It will end on 31st January 2025. Don't count February 1st. It's always a day before the actual day when you started the business. So when it comes to consistency, you should be consistent in everything that you do. You should maintain your books as you used to maintain them during the last financial year. Don't change the way you do your financial account, financial document or financial statement this year from what you used to do in the previous year. So that's what we call the concept or the principle of consistency. You should be consistent. Are we together?
Yes.
Yes.
Now, there is also another thing here. We call it, another example of consistency. We have stock methods. We have what we call stock methods. We normally have FIFO and we have B4. This means first in, first out. Last in, first out. So if you do your stock using these two methods, don't change them. Don't change until you sasa umepata another method. No. It should be the same way you maintain your stock records for every financial year, unless there's a change, unless there's a communication from ISPAC or from the accounting bodies that there's a major change in how the standards are applied. But that is what we refer to as consistency. Okay. Then we have what we call materiality. Number 7 is materiality. When you talk of materiality, it means, I told you that accounting sometimes avoids pettiness. Now, there are items that you start following, you will be wasting your time as an accountant. What you are supposed to do, you should deal with material items whenever you're preparing your financial statement. Because there's a very thin line between being pettiness and being material. Any item that influences the decision that is made by the decision makers is material. And anything that cannot influence the decision being taken by the decision makers is something we call immaterial. For instance, a stapler. When a company buys a stapler, the amount is immaterial because a stapler is 200. Let's say the business is valued at billions. So it's useless for an accountant to be running up and down because of a stapler of 200 shillings. We will see how to deal with those small assets, but a stapler cannot make an investor change his mind. Or a spoon in the canteen owned by a company cannot make an investor change their mind, but their mind will be influenced by material items such as assets. Big assets worth billions of shillings will have an influence on the decision that is taken by the investor. So materiality is very key when we talk about the concepts. Now let's look at what we call duality. 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 What is duality? Number 8 is duality. Duality from the word dual. Duality from the word dual. Dual means two. So duality, this just means double entry. Double entry. Duality just means double entry. So meaning for every debit, for every debit, there must be a credit. So this one we talked about severally. There's no need for me to dwell on it so much, but we talked about severally before. So when we talk of duality, it is just an explanation on double entry. Then we have substance over form. The last one is substance over form, number 9. Substance over form. Now this principle is very, very unique. And you can read, you're being told some transactions have a real nature that differs from their legal form. This principle states that whenever it is legally possible, the real substance prevails over the legal form. Now, I want to give you just an example. If we have a company and this company has bought a loan using a loan, are we supposed to recognize that as an asset, or we wait until the loan is paid to recognize that lorry as an asset? How should we go about it? A company has bought a lorry using a loan of 10 million. Now, are we supposed to recognize the lorry as an asset to the company, or are we supposed to wait until we clear the loan to recognize the lorry as an asset? Which one goes first? Yes, Teresia, give it a try. Yes?
Pardon.
I'm saying,
Yes.
if a company bought a loan using a loan, are we supposed to recognize that loan as an asset, or we wait until we pay the loan to recognize it as an asset? How do you go about it?
We need to recognize.
Very good. We need to recognize it as an asset. So that's what we call substance over form. So in terms of substance, we have the lorry. But in terms of form, it is we bought it using what? A loan. In terms of substance, we have the lorry with us. That's substantial. But in terms of legal form, or in terms of form, it is owned by the bank because the bank gave us the money. So that's what we refer to as substance over form. So basically, what we are saying, we recognize items that have got substance in the company, items that have got an impact in the company despite their legal nature. Are you together?
Yes.
Okay. Let's proceed. Let's proceed. We now want to look at, before that, we want to look at qualities of good financial statements. Qualities of a good financial statement. So let's look at qualities of good accounting information. Qualities of good financial information. Now, financial information are guided by financial users or accountants need to apply quality in their work. So you as an accountant need to look at the quality of the work that you do. Who doesn't like quality? Everybody likes quality. If you want to look for a rental house, unaendanga tu unaingia kwa nyumba yote umepata. Ronald. Is Ronald around?
Yes.
If you want to get if you want to rent a house or if you want to buy a farm, you just take anything you meet. You normally look for quality, isn't it?
Yes.
Yes. So same way, and I've told you, accounting is a profession like the other. So same way, accounting information must be of good quality. We must have good quality for us to be able to be deemed as good accountants. So we want to look at these qualities. The qualities of good accounting information. Qualities of good accounting information. So number one is understandability. Number one is understandability. Understand. Yes. The second one is relevance. The third one is reliability. Reliability. Then the fourth is comparability. Then the fifth, we have timely. So now, when you talk of understandability, let's say you are preparing financial information for your manager. Yes. You know, for you to be a CEO, or for you to be someone leading a company, it's not a must that you study business. Look at former Safaricom CEO, Mr. Bob Collymore. He was not an accountant. He didn't know anything about accounts. Though now Mr. Peter Debwa, the current CEO of Safaricom, is an accountant. He has got accounting training, so he understands. But the last two, the previous two CEOs of Safaricom were not accountants. Yeah? Even Michael Joseph is not an accountant. Look at Kenya Airways. The Kenya Airways, the CEO is maybe a pilot. But these people need the financial statements to know how the companies are running. Look at even the churches. The pastors and the bishops, they are not accountants, but they need to understand the accounting information of their parishes, of their diocese, so that they know the financial issues that are going on. So now, you as an accountant, it is your work to make that information understandable to people who don't know anything about accounting. So behind the scenes, the accountants should do the difficult work of making the accounting information understandable to the guys who use them. Every day, if you look at the newspapers, you'll always find the statement of financial positions, statement of cash flows, statement of change in equity, and statement of profit and loss for companies that are listed in the Nairobi Stock Exchange. So now, that information in the newspaper is meant to be consumed by everybody, some of them, or majority of them, who are not accountants. So number one quality of a good financial statement is understandability, meaning someone who is not an accountant should be able to tell what that information is meant for, or what that information is telling them. They should be able to understand and interpret the figure that you put into the statement. So the financial statement must be understandable, meaning the accountant must look for the best way to make that information understandable. The second one is relevance. So when you talk of relevance, accounting information should be able to influence the important decisions in the company. The information should be verifiable, neutral, and truthful. Now, when we talk of something that is relevant, relevancy. I want to give you a good example of relevance. If any information about corona, people who have died with corona, we know corona was at its peak like 3 years ago. Is that information really relevant now?
No.
Is the information about people who have died with corona on a similar day 2 years ago, that is irrelevant because you are not helping anyone. The disease is gone. So now accounting information should also be relevant. Don't put into your accounting statement things that have got no value. As if it will be 20 years ago in the company, you bring it now, you put it in your financial statements, you will be out of place. You'll be, I don't know, you will be doing zero work. Now, when you talk of relevance, you will need only information that will influence decision of people involved in that business. Meaning, the information should be one, verifiable. When you talk of something that is verifiable, it's something that can be confirmed. Yeah. If we say a company has got assets worth 10 billion, can we go and confirm? Can someone from nowhere go and confirm? Or you are lying? That means that your work is verifiable. For now, if I claim I am in class, let's say, let me give an example of myself. Let's say the class has delayed. Our class has delayed. Sasa now, nawaambia mimi niko class lakini hakuna stima. But one of you anapita hapa na anaingia hapa anaona siko. See, that's a lie. So the information is verifiable. If I tell you I'm here, but I have issues of steamer, of power, and one of you can walk in and find me here, that is verifiable. Something that can be confirmed by a third party, we call it verifiable. The other is neutral. Accountants should not be biased. And one day, if you become an accountant and your boss wants to influence how you work, they want you to be biased, you should reject it. Now, when we are, the opposite of neutral is bias. If a company has made a loss, you are required to report a loss. Don't report a profit to make your boss happy. Report that loss. So you have to be neutral. You should stand alone. You should be able to follow the accounting principles that you just learned. If it's a historical cost, you have to follow it. If it is duality, you have to follow it. If it is what, you have to follow it. That is what will make you neutral. You have to be guided the accounting principles. Then the other one is truthful. You should not lie. Don't start lying about the financial information. So if your information has got those three qualities, that is verifiable, neutral, and truthful, then you can say that that information is relevant. Relevant. Then reliable. What is when you say something is reliable, what do you mean? Now, normally you can use different methods of accounting and arrive at a particular result. So now accounting requires you that whatever results, whatever data that you have, someone can use another method and arrive at the same results. For instance, if you are a doctor, normally, long time ago, I used to hear people who are suffering from HIV. Unapata unapimwa na daktari unapatikana uko na ukimwi. Then they doubt it. Then they go to someone else they go to a second doctor, a third, a fourth, like that. What were they trying to do? They are trying to use the other methods to know if their HIV status is actually true. What if they go to the first doctor, they find they are positive, a second doctor negative, a third doctor negative, a fourth doctor positive? It means there is a problem. Meaning, there is a problem among those doctors. But if this person goes to the second, third, fourth, fifth, and the result are the same, it means the doctors are reliable. Their methods are reliable. Same in accounting. If I prepare my profit and loss statement, and someone else uses another method, they should be able to arrive at the same answer. Now, that is important because if you're an accountant and someone else uses another method to prepare the same information that you prepared and they get a different results, then you will be sacked. Then people will put question marks on how you do your work. People will doubt you. So in accounting, you have to, your information, your work must be reliable. Then we have comparability. Now, comparability is that the information that you provide about your company should be comparable with other years. Yeah, we've said that our financial life of a company is divided into years. So now, when you are preparing your financial statements, we are in the year 2024. We should be able to compare this information for the year 2023. So normally when you prepare your financial statement, comparability comes in where we are able to compare at least 2 or more years with the same information. Or there are companies that are in the same sector. Look at Safaricom and look at Airtel and look at Orange. Now, your financial information should be able to be compared with the information from those other companies. Now, comparability should be carried out with companies in the same sector. For instance, can you start comparing Safaricom business with Naivas business? Unaweza fanya kitu kama hiyo, at you are comparing financial information from Naivas with financial information from Safaricom. Is that allowed?
No, it's not.
Is that really allowed? That's not allowed. So when it comes to comparability, you should compare companies in the same industry. For instance, Safaricom versus Airtel versus
Airtel,
Telcom, yeah?
Telcom,
Another, when we talk of Naivas, we should be able to compare information of Naivas versus Quickmart.
Quickmart,
Another one,
Nakumat.
Nakumat zilianguka. Doesn't exist anymore. Another supermarket?
Yes.
Catches, yeah? Okay, another example, New Nation newspaper versus Standard newspaper. Another one, KCB versus Equity. Which else?
Equity.
Equity versus
Family Bank.
Family.
Cooperative.
Yes, all those. Absa ziko mingi. Now, when we come to comparability, let's say you want to invest. Unataka to invest in one of these companies. At sasa una compare profit ya Safaricom na profit ya Equity. Does that make sense?
No.
It doesn't. So if you want to invest, or if you want to make a decision and you have asked for financial information, you as an investor, the accountant should give you information from the same line of businesses. These are the only people you can compare. So if we say that Naivas is making more profit, we are comparing it with Quickmart and KTF and not with Equity, because these people are in different sectors. So when we talk of comparabilities, we are comparing in two ways. We are comparing the businesses in the same industry, or a business can be compared with its own, with itself. Single. You know, you can compare business on its own. I want to give an example. You yourself, if you want to know you are making progress in life, tangalia hii mwaka ni nini uko nayo compared to last year, si ndio?
Yes.
Yes, utakaa chini upige hesabu. Hii mwaka niko na baiskeli. Last year sikuwa na baiskeli. You can see you are making progress. But again, you can compare yourself with your friends. And when it comes to friends, you only compare your friends with your who are of the same age, the same education, the same social status. Huwezi anza kumpima na mtoto wa Ruto. Though yeye ni mdogo kuliko ama mkubwa kuliko, the social status is so different. Same to companies. So comparability is two-way. You can compare yourself, whereby you are saying you compare two different financial years. You will see a company can be profitable in 2023 and make losses in 2024. Again, a company can do well in 2024, but was doing badly in 2023. So those two areas is how we can deal with comparability. You compare a company amongst its peers in the same sector, or you can make comparison of a company with itself. Because normally, when the biggest competitor to ourselves is normally ourselves. So ukitaka kujua una make progress, utaangalia 10 years ago, ulikuwa na pesa kuliko saa hivi. It means you are maisha yako inaenda chini. But kama 10 years ago you were nothing, and for now you have something, it means you are doing better. So that's how comparability comes about. Then we have what we call timeliness. The financial information should be timely. Now, when we talk of timely, we mean the information that is provided by the accountant should be timely. Meaning, I think I had mentioned it earlier when I was talking about Corona. Information that is provided when it is too late is not good information. For instance, if the company bought a lorry 3 years ago, that information cannot help us now. The information should be timely. Or if someone wanted to make a decision now, and then you bring the information that you needed to make a decision a week later, that information is not useful because it is past the time. If the accounting information is not available to the deserving users at the time of need, then it may as well be useless. For accounting information to be useful, it must be presented to the party in need at the time of the need. So that's the thing. Now let's look at limitation of accounting information. This one you will read, we have historical, meaning the information is outdated. 2, quantitative rather than qualitative. Then only comparable to similar businesses. This is what we were just talking about here. So these ones you will read limitation. There are only 3: historical, 2, quantitative rather than qualitative, then only comparable to the same businesses. So now let's go now and look at the regulators. We want to look at how the accounting information accountants are regulated across the world. Because you as a person, I'm talking about Ronald, Teresia, and who else is here? And Millicent. For now, you are not allowed to call yourself an accountant in Kenya. So you want to look at these, the regulators, the regulations, who regulate the accounting profession. Like in Kenya, look at the doctors. Who controls the activities of the doctors? There's a body called KMPU. KMPU. Kenya Medical Practitioners and Dentists Union. Then who controls the activities of teachers? We have TSC.
Yes.
Teacher Service, TSC, stroke, other bodies. So we have, tunakwamba na wagani wale, NAT, UPET, senior.
Yeah.
But easy as the control we're leading, but this is the control of the teachers board. So now these are the people who make sure that there are no fake teachers or quack teachers. They make sure that teachers are trained well. They make sure that teachers are good in safeguarding the interests of the children. We don't have rapists amongst teachers. We don't have molesters. They make sure they are out. They deal with them. So these are the controllers. And then these ones also make sure that there are no quack doctors. We have so many, you can mention so many bodies that control the activities of professions in the country. Now, if a profession or if a career is left, there will be so many quacks. Ndio nikasema nyinyi bado hamwezi jita accountants because you have not achieved the required skills, the required education, and the required experience. So now, who makes sure that one day you can be called an accountant? That's what we want to look at. Because for now, if you purpose to be an accountant and start practicing as an accountant, you'll be arrested and be charged. I think you'll pay a fine of 50,000. Though, in the private sector, you are allowed to practice. So as you ukimaliza CPA, you are allowed to be employed as an accountant by a private institution. Because one of the business will take the risk. But you are not allowed to go to public. You are not allowed to go to people in the public and start calling yourself an accountant until you are doing their work. You are not allowed to practice on your own. Basically, you are not allowed to practice accounting on your own. That you are doing taxes, you are doing audit, you are doing consultancy. No. You'll be arrested by KASNEB. It's not KASNEB, ISPAC. ISPAC will arrest you. ISPAC stands for Institute of Certified Public Accountant of Kenya. So for you to be a member of ISPAC, you must pass your exams in KASNEB, all the papers. You must have experience of 2 years and you must have a degree. And then you must pay some money to ISPAC before you become a member of ISPAC. At that point, you are allowed to look for customers, practice, and make your own money. And if you're lucky, you can make a lot of money when you are practicing on your own. So, why am I saying that? I want us to look at the people who control accounting profession and the people who make these principles. So we've looked at the concepts. We've looked at the concepts, the accounting concepts. We've looked at the accounting principles, and we have looked at the qualities of good financial information. So now we want to look at who does this. Nani wanakatu chini na anasema, oh, this is how accounting should be practiced. Who is he? Who are they? We want to look at that. And again, going forward, we'll realize that there are so many standards. There are so many communications that come out in terms of how accounting should be regulated. So the first one is the International Accounting Standards Board. The International Accounting Standards Board. So the first board that regulates accounting is the International Accounting Standards Board, IASB. Just like TSA, we have IASB. Now TSA sets the standard. Who sets the standard of how teachers should go to school? TSA inaweza mkatu kesho iseme, for you to teach in the schools in Kenya, you have to have this degree. You will not question, that's all. Now in accounting, we also have a body like TSE, but it's called International Accounting Standards Board. They are the ones who set the standards that are needed in accounting profession. So you'll read here, you read all this. The IASB is an independent private funded accounting standards setter. So you see the standards based in London. So you read that. The objectives of the International Accounting Standards Board. What is their role? Number one, to develop in the public interest. To develop in the public interest a single set of high quality, understandable, and enforceable global accounting standards that require high quality, transparent, and comparable information in general purpose financial statements. Then to provide the use and vigorous application of those standards. That's self-explanatory. Number three, to work actively with the national accounting standards setters to bring about convergence of national accounting standards and IFRS. The other body is the International Federation of Accountants, IFAC, International Federation of Accountants is another body. So these are the bodies that set the standards, just like the ones I was telling you. So this also set the standards, International Federation of Accountants. International Federation of Accountants. This is just a body of the accountants, like NAT or CUPET. This one falls under TSE. This one set the standard. International Accounting Standards Board set the standard, but this is the federation. This is the Union of Accountants. They also help in setting up the standards. Then we have the International Public Sector Accounting Board, IPSAB. The other body is IPSAB. Now this is setting standards for public sector accounting. The accounting that guides the operations in government, like the Kenyan government don't use standards that are set by International Accounting Standards Board. They use standards that are set by International Public Sector Accounting Board. So this and this do the same thing. This one deals with private sector mostly. This one deals with public sector mostly. Then now we come to the one that we have here in Kenya. In Kenya, now we have what we call IFAC, is Institute of Certified Public Accountants, IFAC. IFAC is the other body, but now this one is in Kenya. If you come here in Ruaraka, around Thika Road, we get to what we call IFAC. IFAC is situated at KCA. Those who know KCA University, Kenya College of Accountancy, that KCA University belongs to IFAC. It was established to make sure, KCA was established to make sure that there's good training for accountants in Kenya. It was established by IFAC and is owned by IFAC. So IFAC, for you to be a member, I've told you have to get the required knowledge and experience to be able to be a member of IFAC. So these are the bodies that regulate accounting in Kenya. Then here are their roles: to provide standards of professional and competence and practice among its members, promote research, to promote international recognition of the institute, advise the examination board on matters relating to examination standards and policies, carry out any other function prescribed for it under any other provisions under that written law, do anything incidental or conducive with the formation of the preceding functions. Then we have role of KASNEB. We have KASNEB. KASNEB is mandated. KASNEB also plays a role in the regulation of the accounting body of the accounting profession. Number 5, we have KASNEB. His main work is examination. It sets the examination for the accountants. Then you have their role of RAB. Role of RAB. RAB stands for Registration of Accountants Board. It runs the registration of accountants. So basically that is what it is. But again, there's still something here that I want us to look at before we close this topic. This topic is over now. I'll just mention it. This accounting is also regulated by an act of parliament. Accounting is regulated by an act of parliament known as the Accountants Act. Yes. So it's not just about these bodies. The government also is concerned, and the government also controls the accounting profession through what we call an Accountants Act. If you read this part, we are being told, fast forward, ISPAC, RAB, and KASNEB jointly form the framework of regulation of the accounting profession in Kenya. So we are being told it is important to put accounting in practical perspective. This will be made possible by looking at the institutions that regulate the climate within which the accounting profession is practiced. The Accounting Act was enacted by Parliament into Chapter 531 Law of Kenya in 1977. The Act then established the Institute of Certified Public Accountants of Kenya, ISPAC, the Registration of Accountants Board, and the Kenya Accountants and Secretaries National Examination Board, KASNEB. So you can see that ISPAC, this was as a result of an act of parliament. So if you aspire to be an accountant, know that you are recognized by the laws of Kenya through Accountants Act. And it's that law of Kenya called the Accountants Act that established KASNEB and ISPAC. So basically, that is how the accounting is regulated. Any question on that one? Stacy, you have a question?
No question.
Millicent?
I have an inquiry. If you can give us, let's say,
Yes.
a practice
I'm not
question
getting
for
you.
the statement of financial accounting and the
Yes?
balance. I'm requesting if you can get us a question for preparation of trading profit and loss account and the balance sheet.
Oh, hizo utafanya hata uchoke. That's where next week we'll be doing those, but there's a topic where we will be dealing with all those ones only, but it's good. I'm going to share that question. That's a very, very good idea, Millicent. I'll share on WhatsApp a question for the preparation of financial statements so that we can check on it when we meet next week.
Yes.
Then I was asking, have you done the depreciation?
Then,
Depreciation.
no, we've not done depreciation. So we are going to tackle
Okay.
depreciation in details when that time comes. Depreciation, prepayment, accruals, all that. When we
Okay.
will be dealing with the financial statements of a company, we are going to look at depreciation in details. We are going to look at the straight line method and the reducing balance method.
Okay, thank you.
Okay, welcome. Any other person with a question? So I think we can stop it from there. Then next week, we are going to look at the financial statements of a sole trader. From there, we are going to look at the manufacturing accounts. So next week, we are intending to clear 2 topics. But again, I'll be sharing the questions for you guys to try so that we can see how you guys are picking up. So for now, there's a class that wants to start, and I request to end the class at that point. Is that okay?
Yes. Yes.
Yes.
Thank you guys for your time
Thank you.
and have a good evening.
True.
You too, thank you.